Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Mark Marex, Senior Director of Index Research at Nasdaq. And joining us remotely from Chicago, we have Paul Schroeder, QQQ Equity Product Strategist at Invesco. We're here to discuss performance concentration in the Nasdaq-100 and fourth quarter outlook. It is great to have the both of you with us, as always. Paul, let's kick this off. Third quarter certainly was helped by the mega cap stocks to get the Nasdaq-100, firmly outperforming for second quarter earnings and of course for third quarter fiscal.
You're 100% right, Jill, and thanks again for having me. What we saw from QQQ over Q3 was that it was up about 8.94%. It outperformed the broader market. S&P 500 was up just over 8%. I think what's really interesting and what we saw from the performance within QQQ, though, is that we saw a broadening out of outside of the mega cap names. Obviously, within the month of September, we saw a lot of deals announced surrounding the AI trade, which helped mega cap and Mag 7 perform well. But the first 2 months coming out of the turmoil that we saw in Q2 from the disruptions from tariffs really helped them perform well. I take a look at funds like QQQJ, which was up about 12%, and our small cap strategy that we partner with Nasdaq on, QQQS, was up over 26%. So really impressive stats from companies outside of the Mag 7. Top performers within QQQ, we saw companies like AppLovin, Western Digital, and Intel be the top three performers by absolute performance within Q3. AppLovin has been on an absolute tear over the last year and a half. It's a newer entrant within the Nasdaq-100, having been in it for just about a year now. And during its tenure within QQQ, it's up over 140%. We've seen really strong earnings from AppLovin, with earnings and revenue growing. But we also saw its inclusion within a broader index that was announced in September, which helped out performance as well. As I mentioned before, another great performer outside of the Mag 7 was Warner Brothers. There was a potential cash merger announcement that came through in September that helped the stock pop about 55% over a 3-day period. So again, we're seeing some of these other stocks outside of Mag 7 really start to wake up, which I think a lot of investors have been looking for.
Yeah, they certainly have been. But Mark, we also do have to address what's happening within the AI space and the concentration that Nasdaq-100 names have because of their exposure to it. And, even infrastructure spend has lifted GDP and is driving market optimism. So this is now becoming a macro story as well.
Absolutely, Jill. I mean, you saw sort of macro really impacting the index at the beginning of the year, right? With a lot of the changes in fiscal policy, trade policies. We were in a technical bear market by the time we got to April 8th, which were the lows for NDX this year. And for most other markets, it's just been on a tear since then. I think a lot of people are starting to get the memo that AI is not just an NVIDIA trade. Right, and Paul kind of alluded to this, right? The broadening out of performance. I think the difference in what you've seen this year, which is shaping up to be another solid year for the index, right? Up around 20% year to date already. Depending on which day you cut that off on, there have been some big moves the last couple days, but the performance concentration hasn't been as extreme with the likes of NVIDIA and some of the other names as it has been the last couple of years. And part of that is because, NVIDIA is already priced in to a large extent. It's some of the other semiconductor players that are really kind of catching up now. You saw the big news with Broadcom at the beginning of this week, signing a major deal with OpenAI as well around chips. Intel's sort of back from the dead, which everyone's excited about for a number of different reasons, right? And then you've got names in other areas of just the semiconductor industry like Micron that are really rallying hard as people start to realize that there's a ton of memory that you're going to need to supplement and complement, right, all of the compute processing power that you're getting from the likes of NVIDIA and AMD and Broadcom with their chips. This has been kind of a forgotten corner of the semiconductor market, and you've just been seeing it really light up the last couple of months, and that's helped the index overall, I think, keep up, even if not necessarily the same big names are the ones that are doing quite as well this year as they have the last year or two.
Yeah, and that's indicative of what we saw with the Nasdaq thematic indexes as well, the outperformance within the semiconductor space. But getting back to the QQQ specifically here, Paul, what about macro themes impacting the index or the ETF in this case as it relates to rate cuts and FOMC policy in general?
Yeah, so I think there are several themes, but before I touch on that, I just wanted to circle back to the comment that Mark made about concentration, right? And, we have seen a broadening out of performance, as I alluded to and gave you guys some stats earlier, but we like to take a look at concentration within the fund and within Nasdaq 100 as a whole, going back a far ways. It's a question that we get pretty frequently here at Invesco is around concentration risk. So we like to take a look at it through the lens of Nasdaq 100 and QQQ. And what we've seen purely from a weighting concentration perspective is that we've seen about the top 10 holdings account for about 47.5% on average of the overall weight of QQQ of Nasdaq 100 going back to 1999 when the fund was incepted. I think what's really interesting though is that we don't see concentration within the index and the fund be a great predictor of future returns. We kind of use that average of 47.5% as a gauge, and what we've seen throughout history is that when concentration gets above 47%, we see about a 75% win rate of positive returns the following year. And conversely, when we see it get below, it's about 83%. So concentration has always been within the NASDAQ 100 amongst the top names in QQQ. And we've seen the index perform well throughout the years. On your question about macro themes, obviously there was a lot of news from the FOMC. We got a new September dot plot that they released on, I should say Statement of Economic Projections, which includes the dot plot of where the Fed governors think, the committee members think where the median rate will be going forward. And we saw that shift down to about 3.6%, implying that there could be potentially 2 more rate cuts in the year. We've heard the committee and Fed Chair Jerome Powell take an overall dovish stance over the past few meetings, which I think also helped the environment stay inducive to this equity investing overall. Other things within the area, Mark alluded to the AI trade and all these different potential investments and partnerships that have evolved. He mentioned NVIDIA, obviously with OpenAI. AMD just hit the tape today about announcing a new deal with OpenAI, which again, seen a broadening out and the continued build out of the infrastructure of AI. So there definitely were a lot of things going on throughout the quarter from a macro perspective that I think was helpful.
Yeah, and Mark, I think when you put it into historical context, as Paul just did as well, unlike the dot-com era, many of these AI giants, they have substantial cash flow and they do have earnings. So expectations going into Q4, I think, there's a little bit more sustainability in terms of, how these companies are acting and being able to justify their valuations relative to what we saw in prior eras.
Yeah, Jill, I think the operative word is that there are echoes, maybe, of the AI bubble, but sort of the shape that all of this investment has taken, or at least has taken up until this point, has been very different this time around, right? Because as you alluded to, a lot of it has been, the vast majority of it has been financed by internal cash flow and cash sitting on the balance sheets of the big hyperscalers, Microsoft, Amazon, Google, who just have extraordinarily strong fundamental core businesses. You throw in Meta in there as well as sort of the number 4 biggest spender. Oracle, interestingly enough, which has been in the headlines a lot recently, given some of the deals that they've been signing with OpenAI, is the one major player in this AI CapEx story that is not relying on internal sort of organic cash flow to finance the bulk of their CapEx buildouts. They're actually mostly debt financed. And what's unique about Oracle? They are not in the NASDAQ 100. They used to be years ago, but they're no longer a NASDAQ listed company. And so kind of funny enough that when you think about, to the extent that some of this behavior, some of the moves that you've seen in the market recently and some of this news flow is echoing and reminding people a bit about the AI bubble, you take a look at the fundamentals underneath and you see, a forward earnings PE on the index in the upper 20s today. Towards the late 90s, you were well above 100, even in some cases over a 200 PE on the Nasdaq-100, as many of those companies were not profitable even at the peak of the dot-com bubble. And the sort of one company that maybe is raising some red flags in terms of sustainability, not in the index. So very, very different story for a number of different reasons.
Yeah, it certainly is. And Paul, when you think about your outlook for the fourth quarter, does the government shutdown play into this at all? Because we do know that the market and the economy are two different things, and the market reacts differently to shutdowns than than the economy might necessarily do, or how Main Street might interpret it. Government shutdowns, for the majority of the time, the market has been positive. So there's a big dichotomy there between what we're seeing in the markets and what you might be experiencing on Main Street. So what's your thoughts there for Q4?
Yeah, so I think the government shutdown, as of today, hasn't had that great of an effect. I think there's potential that it could, the longer that it lasts. There have been talks about potential layoffs coming from the shutdown. So we'll have to see how all that plays out. A stat that I saw this morning is that this is the 5th longest shutdown that we've seen thus far in our history. So definitely not the longest, but it's creeping up there. I know the Senate is meeting this evening, 5:30 Eastern time, to call for another vote, but it seems like many people aren't expecting a resolution today from that. Throughout this entire time, though, we're seeing around 750 government workers who are furloughed at the current time. And I think more importantly, what we are seeing from this is like the different functions that people like Mark and I and you rely on, releasing of potential data that helps give us insight as to the strength of the economy. One that comes to mind immediately would be like initial jobless claims, et cetera. We're not getting those releases right now. So I think what we could see here down the line is that once the government does open up and some resolution does come, we get a big data dump that could have the potential to move the market depending on where that data falls.
Yeah, it seems as if, though, the Nasdaq-100, many of the names don't necessarily move as much off of the data, or they don't have such direct exposure to it, such as small caps, as an example, right, where they're more data dependent as it relates to production numbers and rates and so forth. It seems as if they're a little bit insulated from some of these data points.
I definitely would agree with you on that. I mean, if we think about the overall exposure within Nasdaq 100, everyone has, associates it with as being a tech fund, which I can understand, about 50-60%, right? So you tend to see it be a little bit more sensitive to interest rates, which Mark could talk your for hours about how that might not be the best gauge. Interest rates as to how the underlying components are performing. But I think overall, though, what you're seeing is that since they are technologically focused companies that have been driven by years of R&D spend, which has translated to strong fundamental growth, I do think you do see a little bit of insulation. Now, obviously, with the recent news that we saw from last Friday about a re-escalation of uh, potential tariff war between the U.S. and China, QQQ and the Nasdaq 100 was down more than the broader market on Friday, but we did see a nice bounce back yesterday as news came out about meetings still being on with between the U.S. and China to hopefully resolve this and not have it lead to potentially 100% tariffs on Chinese goods coming into U.S., which are slated on November 1st. So I think some of these larger, broader themes might have potential to move the companies within QQQ. But I think until we get a clear line of sight on this data, I think it's steady as she goes.
Yeah, Mark, it almost felt as if it was a release valve, if anything else, if you were looking for an opportunity to take some money off the table or to rotate. I mean, if you're underperforming your benchmark as a portfolio manager, you're going to put it into these types of names. You're not going to go into small cap when beta is that high. So the rotation and the recovery that we saw, it's almost a self-fulfilling prophecy in a way. Once you get these opportunities for slight pullbacks.
Yeah, and I mean we've had a number of smaller pullbacks since this AI trade really got started about 3 years ago. Now, right, was when ChatGPT was first released, sort of in 4Q 2022. We had that big carry trade blow up last summer where things got scary for a few days. I think right now, we're on day 3 since the Friday announcement, day 3 in terms of the market. A little bit too soon to tell. Is this going to lead to something, more systemic and more pervasive? or is it just sort of posturing ahead of upcoming negotiations between the two sides? But I think when you kind of put it all together, right, you know, what we've been talking about earlier in terms of the Fed starting to cut rates, starting to get more dovish, the government shutdown, this tariff threat again, like these are all factors that together have helped broaden out, I think, market performance for things like small caps, you know, the QQQS that tracks the, you know, top 200 most innovative small caps at Nasdaq, or QQQJ, which tracks the next Gen 100, which is sort of the next 100 largest beyond the Nasdaq 100, a pipeline into the Nasdaq 100s, if you will. These are areas that had been struggling a bit because of that higher rate environment. And so, you know, counterintuitively, to an extent that we do have more macro damage from the government shutdown, from uncertainty around tariffs, maybe that leads the Fed to be a bit more aggressive in the coming meetings, the coming months and quarters. And so that should actually help not only broaden out, you know, market performance, but to some extent also enable this AI trade to go further, right? Because to the extent that Oracle's already there in terms of having to finance this with debt, to the extent that some of these other names feel they need to start looking at debt to finance an ongoing ramp in CapEx, lower borrowing costs makes it cheaper to do so. So it could actually make the trade go even a little bit further. So something to pay attention to and think about, I think.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.